Food and alcohol delivery service MilkRun will cease trading this Friday, less than 2 years after launching. Its founder blames the worsening economy for the collapse that will make 400 staff in Melbourne and Sydney redundant. Startup raised about $75 million through providing a service promising super-fast grocery deliveries. Wasn't enough in the end. Joining us live now, Associate Professor at UNSW Business School, Mark Humphery-Jenner. Mark, good to see you. So was it the climate or was it the business model that just didn't work?
Well, firstly, thanks for having me. And to some extent, it's a little bit of both. So the climate obviously made things worse, but MilkRun was already losing money. So they were reportedly losing between $10 and $13 per order, and it was costing them at least $50 to get each additional customer. So they were already losing money. Investors had already turned down funding twice in 2022 to put more money into MilkRun. And we'd already seen companies like Send or Volley go under. So to some extent, MilkRun was really facing an uphill battle. Then the economic climate made things worse. So for example, the cost of living crisis was reducing people's willingness to pay for just short deliveries. In addition, costs were going up due to labor costs going up, rents going up, everything going up in cost. And both of these combined together, plus the increased cost of money, meant that MilkRun was ultimately facing an uphill battle to continue operating at the moment.
Do you think investors would have been given advanced warning of how perilous the business environment was for MilkRun?
Certainly, to some extent, investors had this advance warning. So all the way back when they put the $75 million in, well, that was actually quite some time ago. So that was supported by companies such as Tiger, such as Airtree, such as Grok, which is backed by Matt Cannon-Brookes. Now, they put that $75 million in, and then MilkRun was seeking to raise more money, and they were seeking to do this during 2022. However, the investors looked at the pitch deck, so looked at the information coming through, and declined to put more money in. So they had some advance warning, but that advance warning came in after the $75 million check, and hence why MilkRun was having these issues raising money.
We've seen what happened to Deliveroo. We've now seen what happened to MilkRun. There is a theme here, Mark. So what does this say about the future of food delivery services?
It does send a signal that it isn't super viable just on the delivery fees alone. So say, for example, we're looking at delivery companies or delivery divisions run by Coles or Woolworths. Those could potentially be run because Coles and Woolworths have economies of scale, they have a lot of scale with their customer base, but also because they're so directly connected to what Coles and Woolworths are doing, they can potentially either cross-subsidize what's happening, it could be used as a loss leader, or potentially it could in fact be somewhat profitable if it's put within the overall organization. But if we're looking at the independent companies, such as Deliveroo, Send, Volley, or MilkRun, well, they're facing a lot of costs that simply don't make it viable in a country like Australia, because a lot of our population is so dispersed, so spread out, that it's simply very, very difficult to do 10-minute delivery and actually being cost effective, without having to spend a lot of money on a lot of high-cost labor that you simply won't be able to make money back from with your delivery fees.
So essentially, I mean, above all of that too, the costs for having the riders there was too much, too expensive.
Absolutely. So MilkRun had about 400 employees, and MilkRun was eschewing the independent contractor model. So the way a lot of these companies will do it, so Uber, for example, is the deliverers will be independent contractors, which means they can potentially be paid less. They might not even get minimum wage, especially after you factor in costs. And there are a whole lot of expenses they don't need to factor in. Deliveroo was trying to get around that and, in fact, be better for its employees by making them full-time employees to some extent, or at least part-time employees. However, this adds on to the costs. While it might be good for employees if the company continues to operate, it certainly isn't if the company ultimately goes under. And that really made MilkRun even more expensive to run than it already was.
Interesting. Mark, appreciate that. Thanks so much. We'll talk to you soon.